Hey there, Seb Fry the Realtor here, and today down at my Compass office in beautiful Los Gatos, California, we had the folks from OriginPoint Mortgage Lending come and do what they call a lunch and learn, and I got a front row seat. I was there with my iPhone and my tripod, and very casual, but I was right there, and I took a video of it. And if you haven't heard about OriginPoint, they are a new subsidiary of Compass. They are the Compass mortgage lending arm, and it's really, I guess, kind of like a front end for Guaranteed Rate or Rate.com or whatever they are, one of America's largest mortgage lenders. So it's kind of like a joint venture with those guys. But they do have some real heavy hitters in the mortgage industry who are working for them, and they got a panel discussion together, although the panel was virtual, but we did have their top lender here in our office. And it's kind of like an advertisement for OriginPoint. That's kind of the idea. They want all the Compass agents to send their deals over to OriginPoint, even though we have our established relationships going back decades maybe with our favorite lenders. Nevertheless, they want to try and win the business, and so there is a little bit of that kind of like commercial rah go OriginPoint stuff in the presentation. But it was really all about appraisal issues. And so a lot of the agents in the room, I guess there were maybe about 40 agents who had assembled, they asked a variety of questions about appraisal issues. And a lot of these questions are ones that I honestly hear all the time. And I knew the answers to most of these questions, and the answers are really, spoiler alert, I'm going to, give away the game right here, but basically the answer is, it depends. So much is dependent on like the actual house in question and the comps in question. It really all comes down to can we lend on this? It really depends so much on the house and the comps, and that really is it. But I know that if I found it interesting to at least sit through this, it's about an hour long. I'm guessing that a lot of other people will also find it interesting to know. So I just thought I would put this together and share it with the world, because I am sure that many people out there will find it to be of some value. So without any further ado, please enjoy this Lunch and Learn panel discussion about appraisal and underwriting standards as of January 2023.
All right, thank you everybody for coming. We're going to go ahead and get started. I'm going to make this brief. Most of you have already met Risha. One name says it all. The number one female loan originator in the country, did over $830 million worth of loans on her own. So she carries a lot of credit, street cred with the higher ups at financial institutions. One of the things that we've been talking about locally is how are appraisals and those kinds of things affecting our market, with the shifting market, and how do our partners at OriginPoint bring some value add to that equation. She has put together a world-class panel. We're not talking about junior loan officers and off the street, junior underwriters and these kinds of things. I'll let her introduce her guest panel, but if everybody give Compass a warm welcome for Risha.
So if I can get people this way so they can see you and be happy that I attracted all of you here today. It wasn't just the food. So that way you can see the panel, you can ask them questions or anything you want. So just so you understand, what you have in front of you is rare. These are not just go-between, these are not the middlemen, these are not junior underwriters, these are the heads. And when I say the heads, there's nobody above them. The people on the panel, you've got Chris Bakoviak, who is your SVP of Collateral Production, which means I need more appraisers added on. I need this going ASAP. What can we do? We need anything to do with getting people on, getting them assigned, making sure it comes in, everything is perfect. He runs that. And when you say we're putting together a panel, it's not just a guy from Fairfield for Los Gatos, right? We make sure the people that we give you are local, that know the market, know school districts, know what the next street is going to change. It's not just anywhere. That's why we don't see issues with appraisal. You've got Ricky up there right now. He's the collateral underwriting manager. Anything when an appraisal comes in, it's reviewed. It doesn't just go out and go, here's a value. It's reviewed to make sure it's right. If it's flawed, he manages it for me. Then you've got Lindsay right there. And Lindsay, believe it or not, is the head, when I say the head of credit, the absolute head of underwriting, which is any product, any bank, any investor, she runs it. It's her underwriters, her juniors that approve loans. But if I need a favor, I need an exception, I need whatever it is, I text Lindsay. It could be on a weekend, I go, can you do this loan? Will you approve it for me? I gotta do something fast. That's who's on that call, right? The absolute highest level, which you would never get at a big bank otherwise, right? So this is your panel here that is available. Take advantage. Ask the questions you were afraid to ask.
So I'll start just so you guys aren't shy. I'll start. You know, one of the things that we run into commonly in our marketplace, right, is you get an appraiser out there, the market's shifting, and we're having a situation whereby they check that dreaded box on the appraisal that says declining market.
I think I'll jump in, go ahead and tackle this one first. I loved how you put that the market is changing, then went into declining. So we would treat either increasing market or declining market the same way. What we would want to see is comparable properties that are the most recent we can have, because at that point it eliminates the need for adjustments or reduces maybe the amount of the adjustment by not using a sale that's terribly dated. What we want to avoid is in that increasing market using sales that are so old we're taking a value prior to that great increase, and the same thing in that declining market. We use a sale that's very dated. We might not be capturing that true essence of what the market's doing today. So to hinge on that, I'll say the investors, there's no specific requirement right now that if the box is checked declining market on page 1, that here's criteria that have to be met. You know, the investors want to see the most recent sales all of the time. A more rural property may not have very recent sales, so everything's kind of with that grain of salt depending on where that property is located. But again, the key is going to be, again, whether the market's increasing, stable, or declining, you want to have the most recent sales possible.
Now, I think one of the big challenges that I see, or when I get called in is, oh my God, Risha, I went with ABC Bank or whatever, they checked declining box, and now they're saying either they cannot do the loan, or B, they need an increased down payment of 5%. Lindsay, do we do any crazy stuff like that here?
The firm, no. I mean, we read them. I'm going to just change guidelines, right? We're going to go by, what we adhere to, what the rest of the loan looks like, yeah? Sorry, guys, I froze for a second, but you got the good answer, right?
Yeah, so if you see a declining market check by a bank that's saying, no, they cannot lend here now, no, you have to come up with a 5% additional down payment, we don't follow that, okay? Like she said, we look at the big picture, everything looks okay, we're gonna lend at the same terms that we promised a client. We don't change our guidelines, all right? So that's a big one. Next question, ask away. The question that was asked is, how do you define recent sales? 2 weeks, 6 months, 1 year? What do you look at that qualifies as a valid comp?
And how many?
And how many do you need?
Especially because the market has changed, right?
Okay, perfect.
Okay, so I just want to make sure. So every appraisal is required to have at minimum 3 closed comparable sales. Can have more than that, but at minimum have to have 3. The most investors will indicate in their guidelines that the 3 closed comparables should be within a 12-month closing period of the effective date of the appraisal. But when we are in a market with either increasing or decreasing market value trends, the term recent is somewhat relative. We can't fabricate sales, so we'll have to take what's available in the market. And if 2 properties are identical, one sold, let's say 3 months ago, one sold 9 months ago, most would agree that that sale from 3 months ago is more relative in that, let's say, volatile market condition. So there is no definition of what constitutes recent, but relativity. Again, something that has a more proximate closing date to the effective date of the appraisal versus something that has that older effective date, assuming all other conditions are the same.
So there's nothing like black and white. It's gotta be in the 3 months. It's gotta be 6, whichever comps. And again, we're not as picky as big banks. Whatever comp makes sense and is better used to support the value, we'll go with it. All right? Go ahead. The question was, in what situation do you do more than one appraisal on a given transaction? Lindsay, you want me to take this one?
Sorry, it's sort of hard to hear.
In what situation do we require more than one appraisal?
Oh, well, it depends on, it depends on the investor, really. I mean, that's the biggest thing. We're not going to all of a sudden require multiple appraisals because we don't like what we see. I mean, Ricky or Chris, I don't know if you have any more flavor to add to that, but how generally we don't just add. I mean, if you guys would see more, especially on the jumbo side, right? That's where my brain's going. With why we'd ever need multiple, but you wouldn't just ask for one because
Yeah,
you
I think
wanted
it's
more solid proof or anything like that.
I
I
think
guess is what I'm getting at.
for the
Yeah,
panels.
the biggest driver to having more than one appraisal is really more the investor-driven guidelines on anything that we may or may do. And in this environment today, obviously banks, as Risha had mentioned, are a little nervous about certain things that are going on. So they may ask us to give us another product. It doesn't necessarily have to be an appraisal. It could be a different type of product that we can do to verify the value. And the good news is when we do that, we're probably getting a little bit better rate because they're a little bit more comfortable with where that value is as we're kind of going forward. But it's really going to be investor driven. And again, depending on the jumbo and what product we're going to go to, that's kind of where it's all going to depend what we use.
So this market is predominantly jumbo, okay? I'll just wrap it up. One appraisal, two appraisals, one appraisal field review, one appraisal desk review is predetermined. Anybody who just makes it up or say, by the way, we need one appraisal, garbage. When I am doing a loan, when I am issuing a pre-approval, I did one yesterday, I got a rescue a loan, 1.85, 10% down, 5 people said no. That investor that I am placing him with, and in this case is North Point, guideline says 10% down, a loan over $1 million needs to. There is no ifs, ands, I'm gonna randomly figure it out. It's set, right? So I know going in on any loan that I am placing, and if I have targeted a bank for him, this is the outcome. It's all of my guidelines are there beforehand. So you let the client know this one needs to. If during the process or when the offer is accepted, another bank comes in that's favorable rate-wise and needs one only, unless the loan is over 1.5, then I'm gonna say, now I need one. But we don't, or they don't, arbitrarily add appraisals. It's already set across the board based on loan, purchase, down payment. That's it. That's what determines risk, and that's what determines do we need one or more. Now, if there is an issue where you have a fire, you have floods, or you're in an area that was impacted, then we will add, you know what, let's just do a 1004D, make sure your house was not impacted with the rains, if you fall in that category. Otherwise, we don't change our stuff, all right? Go ahead. The question is, how do you calculate adjustments or look at adjustments for ADUs or garages, either with or without permits? Now this, guys, is a real jumbo market, right? You're looking at a $2 million price point, typically, or 1.5 years. So how do you look at if you see a property with a permitted or unpermitted ADU garage in this? Go ahead.
All right, so I will jump into this one, and Chris and Lindsay, more than welcome to tag on when I'm completed. So the first thing I want to cover is permitted versus non-permitted. In the investors, it seems for some reason, and I review appraisals from all over the country, it seems for some reason in California specifically, appraisers will take an approach that because something was, I'll say modified, maybe added to a property, converted, or modified from another structure, because something was done without the benefit of a permit, that they can't give value to it. And I don't know where that has started from, but that's not what the investors' guidelines indicate. The investor guidelines indicate, and it doesn't matter whether it's an ADU or just to a property, that if it was done without a permit, the appraiser just has to comment on the impact to value and the quality of the workmanship of that addition. It may have value, but again, I just wanted to cover that. It seems for some reason in California, we get a lot of appraisals that report, because it wasn't done with a permit, I can't value it. I want to hinge onto that. It's different indicating something was done without a permit than something was built that doesn't offer zoning compliance, where that's where we start to get into that ADU scenario. In an instance where a property has either added or converted space into an ADU, if that zoning for that property does not allow an ADU under any circumstance, that might be considered an illegal improvement. So it's not zoning compliant, not having anything to do with the permitting of it, but again, just a different way of describing that. As far as the reviewer, I don't have to determine what the adjustment is. That's the appraiser's responsibility. My responsibility would be, does the appraisal offer reasonable support for that value, say the value of that component, that accessory dwelling unit? That's going to be based on the information that's in the appraisal. A perfect comparable would be an identical property to the subject. We never get that, so the appraiser has to rely on the differences to account for within the appraisal, coming up with those adjustments, and hopefully have either matching properties where we don't have to come up with that adjustment, or the appraisal provides reasonable adjustments within their data set. So Fannie Mae, Freddie Mac, they all have, I'd say, a split set of guidelines, whether, and again, if we're going to take an example of a property with an ADU, if a property has an ADU and that ADU offers legal zoning compliance, it's kind of one path of completion. If a property has an ADU and that ADU offers illegal zoning compliance, there's a second path. Not to say that it can't be done, it's just a different way that the appraisal has to provide data within that appraisal to support the improvements. So it can be done even if the zoning doesn't allow that ADU. Just a kind of additional comparables and additional work for the appraiser, but definitely doable.
The question is finished basements. Can they, I guess, be counted towards value? Is that the question?
Correct.
Or how would you treat them?
For how much?
A finished basement.
Yeah, finished basements. So any characteristic of a property can increase the value. I'm not saying that it automatically does. If you're in a market where a finished basement, let's say, is common, and there's comparables that support, based on these sales, somebody would pay more for a property with a finished basement, then that kind of becomes the basis for that adjustment. It holds true really for anything, a pool, ADU, Mountain View, somebody willing to pay more for that feature or amenity, supports that feature, amenity, or characteristic has value, towards an appraisal.
So does that mean we have to find comps that have finished basements also? Or what if this is a property that's the only one with a finished basement? Can you give value to it if you can find a similar comp in a reasonable distance?
So a two-part answer. Ideally, the best comparables would be the most identical to that subject property. So again, if we're talking a property with a finished basement, let's just say it's a full size, so the same floor area as that upper level finished floor. If we had some comparables that had finished basements, whether they were full or partial, that would be ideal. When we start to get into characteristics that can't be matched in the subject, we start to kind of go to, I don't want to use that U word, that unique word, because the investors don't like that. So we get to maybe an atypical property or maybe a slightly non-conforming. Again, not to say that we can't do a loan on that property. It just gets to be a little bit more difficult, and that we want to see maybe dated comparables, sales beyond that 12-month period that we're looking for, or maybe expanding the search parameters a little bit for the appraiser to provide support for the component of value that they're offering. Again, say it's a finished basement, finding something that helps support their adjustments.
I'll ask one. I got a bad appraisal. My house is listed for $2 million. My appraisal comes in at 1.8. And I firmly believe I have one of you guys, the experts in the industry, that tell me, Rish, this is worth $2 million. You got a garbage appraisal, right? I mean, let's just say it's not me, it's a big bank. What do we do? Or what's our process, guys, if an appraisal comes in below value and we firmly believe the value is supported? What would you guys do or ask of us as loan officers?
So the first thing we would do is we'd go to you. We have a form we call a reconsideration of value. So we would go, if you firmly believe it's $2 million and we think the appraiser erred on a 1.8, well, the first thing we're going to do is tell us the comps that you have that are, that are similar to the subject, very recent, that the appraiser is not using, and then my team will call the appraiser with the form and say, can you comment on this? Can you tell us why you didn't use these, why you're not using these as representative of value, and then, we'll go from there. If, for some reason, an appraiser comes back to us and says, well, you have a 2,000 square foot home and you're giving me 3,000 square foot homes, those aren't like subject, and we still firmly believe that it's closer to the $2 million mark, we would send it over to our collateral underwriting team, which is, we have a group called appraisal or quality assurance. And what they would do, they're a group of licensed appraisers, just like Ricky, and they would actually go through and look at that appraisal to see, okay, what's going on here. And if they do deem that appraisal that is lower in value, it's got material flaws, then they would come back to my team and we would go order a second appraisal on a rush basis and get that one back in and then get that one re-underwritten. So basically, in a nutshell, if a value comes back and we're not happy with the value, we have a very defined process in which you can give us how you came up with the value. We'll put it on a form and we'll send it off to the appraiser and have them comment on it for us. And if, again, we still are, pretty sure that that's not the right value, then we do have a group of appraisers that'll review that appraisal and say, yep, this thing's not very good, go get another one, we're good.
So what I want you guys to say is, this is not a big bank. This is not somewhere that you send in a form and you know darn well when you're sending it, nothing's going to happen, right? Because you got a bad appraisal. This is different. I mean, you'll give me the comps and I trust you because you're the expert, and I'm going to call one of these guys and I'm going to say, I believe you that this value is wrong, and they get going. So it's not getting lost in the shuffle. It's not where your voice is not heard. And again, I trust you. You know the house. But I will reach out. And in many cases, we'll order a new appraisal on our dime. Borrower doesn't pay, and we'll go with that value. I mean, that's the level that I will push, right? And sometimes I've gone 3 and I'm going, nope, still not good enough. We gotta go where I believe you as an expert know the area better than me, all right? The question is, when you order a second appraisal and when it comes in, which appraisal do you go with? Do you go a combination? Do you go higher, lower? What do you figure out as the value of that house?
So I can answer it like this, and then Ricky might want to jump in on it too, but we don't go based on which one's higher or lower. We go off of which one's more credible, which one's the better of the two appraisals as it goes through collateral underwriting. So they don't start out and say, oh, here's the value and we're going to take this one or this one. No, they look at both of them and then they evaluate both of them and say, we'll take the more credible of the two, and that's the one that we will use.
Fantastic question. You're looking at writing an offer on a fixer-upper property, right? At what point, or what makes it something that we would not lend on? Or what are things we're okay with, and what are things that are an absolute hard no for us to do alone?
All right, I'll jump into that one. I think we'd be hard pressed to say that there's something we couldn't do a loan on. I think it would just depend on what loan we're doing. So, a fix up, if I think light fix up, something that needs, flooring, paint, and, some updating, it seems like it would be no problem. That's something that's typically just condition related. If we're talking about a property maybe that's been vacant for several years, maybe it's been vandalized, maybe there's some broken windows, maybe there's some higher deferred maintenance issues, the appraisal can be completed subject to the repair or correction of those items. Fannie Mae, Freddie Mac, they unfortunately don't give a specific list. They give generalities. The property has to be structurally sound, livable, and have no safety concerns. So, say a property that has a hole in the roof, that wouldn't be acceptable as is. We may be able to do an appraisal or have an appraisal completed subject to, I'd say at minimum, the inspection of that roof, but likely repairs of that roof. If the property is such that the list of repairs are extensive, I think it would be putting that borrower in the correct loan for a renovation loan or something where repairs can be brought into that loan package so that the appraisal will report exactly what we have and then also what's to be done to the property.
Let me ask a question. The house doesn't have a heater. The house has mold, mildew. What do we do when we see something like that on an appraisal, right? There's some water damage. What's our take when something like that? And think jumbo, because a lot of these guys are jumbo, so you'd probably go Lindsay, BU AUS, Chase AUS, you know what I mean? Think AUS would be a program that I would run it through, right? For these investors. So it's got some stuff on it. Your roof is okay, but no heat, maybe mold, maybe mildew, maybe water issues.
All right, I will jump in here again, and then Lindsay, if you want to tag on to the end of it. In no particular order, I would hope that the appraiser would call out, because the appraiser gets to be the eyes and ears of the lender. We don't get to see the property. I don't get to see the property other than those photos. So when the appraiser is there, I would expect that they're aware of that investor's guidelines and know what will be acceptable as is and what will be requiring repairs. If we get something that we see that's a red flag, we'll want to ensure on our side that again, if there's a concern that the appraiser points out, let's say for mold, we'll want to ensure that we have that minimum in inspection, because an investor is going to want to see that we've had that addressed. I'm trying to think what you noted as a secondary concern. What was the second thing you said? Mold, and what was the other one? Water damage. If the water damage gets to be a little tricky, if the result of the water damage is, let's say, stained drywall and some minor drywall damage, cosmetically that may be okay, but we would want assurance that the cause of that problem has been addressed or corrected. In the instance, let's say a pipe broke in the wall and we have evidence that that pipe has been repaired, it could be okay with that existing cosmetic damage. But if nobody knows why the wall is stained and nobody knows any history of what was behind it, at that point we would probably want at minimum an inspection to determine the cause of what that water damage was and if repairs are required.
Go ahead.
Yeah, and I'll piggyback a little bit, just in the fact that it just sort of speaks to our credit and collateral, I guess, altogether relationships with each investor. Here's the thing too: we do have direct access. If there is confusion, or if there is, discrepancy, or there's always going to be one-off situations, right? I would say the loans are like snowflakes. They really are, right? So we do have, everyone's different, right? Every situation's different, every risk factor is different, even on the collateral side, right? But we do have, if we're seeking clarity, or if we're on anything, and this goes for a credit or collateral, and gentlemen, correct me if I'm wrong here, but we do have, direct relationships with the heads of our investors as well that we can collaborate with, right? So we're just not going to say, just cut you off right there and not investigate it further. We'll do our due diligence. I guess that was my long-winded way to say that.
If I could add to that, off the record, I'll call them and I go, guys, help me out. I need a way around it, right? What can I do? What can I do? How do we make it work, right? And they'll always go, here's a loophole where we can put it together. We did a loan recently for an agent at Compass that bought his own house, and there was termite work for almost $50,000. That accidentally title sent the report in, and we're like, what the shucks is this, right? So now we've seen it. We can't unsee the darn thing, but they let me do a holdback. Jumbo loan, we didn't repair. Sellers aren't gonna let me. We're like, all right, we're gonna do it later. You're gonna do it anyways. We'll just collect the money up front. When you finish the repairs, let us know, right? Most cases, most banks would say, gotta get done before funding. No way around it. It's $50K. Lindsay said, collect the money, Reach, put it in escrow, we'll fund the loan, let him do it later and let me know it got done. That's the difference, right? It is your mortgage company, literally your mortgage company, that will help us figure out how to help you. Got it? Wait, that's the gentleman behind you.
If I heard Rick correctly, he said the appraiser or you guys will order further inspections on items that are not clear, say for example structural damages, right? You see just 1 or 2 pictures of some horizontal cracks, and then if the appraiser points that out, do you guys take it a step further?
We don't. I mean, if the underwriter calls on it, right, somebody from Lindsay's team sees the appraisal and says, I need a little bit more, we are not doing the inspection. We're going to call you and say, do you have anything that says it's just a hairline and doesn't impact this, the structure of the property? We go by what you give us. It's very rare for us to send an inspection out, and that could be foundation or whatever. We don't do that. We trust you got us a report from somebody licensed that tells us it's not a big deal. Clear? But we're not sending our guys out. We don't have people like that.
So if I'm representing the buyer, we obviously don't have access to do more inspections, and the report is the only report we have access to, where there's just 1 or 2 pictures, but the appraiser feels that it's a major structural issue. It could be $100K or something. How do we respond to that question of yours, I guess is what I'm asking.
So and I'll give you the answer. The question they asked is, there is something on the appraisal and it looks like it's a crack. You may think it's a massive issue. It's not a massive issue. They can get an inspector in because as a buyer, they may not be allowed access. In that case, am I right that I can get something from the list side or some inspection report that attests that it's not as big of a deal as the appraiser puts it? Lindsay? Ricky?
Yeah, I mean, in my experience, yes.
We'll just go with whatever the list side gets me. And I'll work with him or her because I will call them straight up and say, get me something that shows exactly how good or bad this crack is, right? So you don't have to worry about it.
Yeah, I mean, it's in everyone's best interest to sell the home, right? I mean, and generally they'd be agreeable. And as long as it's documented properly, permitted, I mean, whatever the issue is, right? That's the key, right? It doesn't sort of matter who it comes from, but as long as it's, the correct professional looking at it, not, me or you.
So he's saying you've got a subject property, a similar comp is 3 miles away, right? But you also, and it's in the same zip code, but you've also got 2 homes that sold across the street from the subject property, but they come under a different zip code, different school. Different zip code, different school. Which comp holds more merit?
Alafra, the way that guidelines are written, the comparable that has the most similarity to the subject. So it's not relative to the actual distance, although that's one of the components. I will say a house next door probably has some greater advantage than a sale 3 miles away, but that sale 3 miles away, like we mentioned before, may be that one with that finished basement and the pool and the view and all of the amenities and characteristics that the subject has. Where that house next door, and again, kind of to use your example, it may be in a different school zone, school district. It may be in a different zip code. It may be, again, other characteristics that just because it's the most proximate might not be the most overall similar. So the investors don't have a specific guideline to the distance to a comparable. There is no sales have to be within X number of miles or X number of city blocks or anything like that. It just has to be the most similar properties to the subject. So again, to ad lib that sale that's 3 miles away may be the best comparable available.
in our market, we have a lot of what I call micro markets, right? On one side of the street, you got semi-custom, custom homes. On the other side, you got a KB tract home, different schools, right? One might be a California distinguished school, and the other might have really poor, greatschools.net scores or what have you. What they're really talking about is the credibility of the appraisal. So to Chris's point earlier, I think it's really having the local appraisals that know the area are going to know where those are and have the right properties documented in the appraisal before it hits underwriting.
Yeah. The question was, you've got a property that was appraised twice within a 3-month or a short window. The first appraisal was to a refinance. The second appraisal was the purchase. Is there any difference in the way we would handle a refinance appraisal than a purchase? Do we do anything different when we place the orders for refi or purchases?
Chris, you're muted.
Oh, yeah, I think you're on mute.
Sorry, as far as placing the orders, there is no difference on the orders themselves. Now, there's obviously on a purchase, the appraiser is going to have to look at the purchase contract and review that, but on a refi, they don't necessarily need to. The same methodology on how they're going to come up with the value should be the same on both of them.
So no difference, right? Purchase?
Well, oftentimes there is a difference.
No, there shouldn't.
I mean, in the valuation, you oftentimes sellers will say, well, we just refinanced 3 months ago and it was at $2 million, and now they want to list something at that price when you know that it's $100,000 or $200,000 less.
Yeah.
And then you have to convince them that I don't know what they did during that refi, but and no modifications in the house, just some time went by. They're expecting us to evaluate it at that refi price when I don't think that's the value. So I was wondering if there was a difference.
Shouldn't
when
be.
an appraiser does
I mean, the only
a
thing the
refi
appraiser
versus
sees
a
different
sale.
on a purchase is he sees the contract, right? And his job is the house in line with the price? Is it lower? Is it higher, right? But he has like a benchmark to go with. Often times or not, they don't have that benchmark on a refinance because there's no contract price, right? All you're trying to refinance is the existing loan amount, and the value of the house is up for interpretation, correct? Whereas in the purchase, he's got a finite number. He's got to tell me, is it worth the price I'm paying or not? So sometimes that creates the friction. Sometimes it could be bank A versus bank B, and how. And I don't know, maybe it's appraiser's mindset that, oh, it's a refi, not as critical to have the value versus a purchase. You know what I mean? It could be a mindset. I don't see that as much, but if there is something that comes off like they said, we'll throw it out and get another one.
Question was, if you have a home that falls into a district and there's a school district, but they maybe are splitting time where they can go to multiple districts, how do you take into a fact that in a very small area you might have multiple choices, and let's say one school is higher ranked than the other? How do you interpret, or how do you go through the process of understanding value based on the schools?
Again, kind of going back to the whole comment about our panel, is we have a set of appraisers we're comfortable with, that they know those markets and that they understand those differences and those nuances that may happen from block to block, or even from neighborhood to neighborhood. And so as they're kind of going through it, we are trusting these are appraisers that we've done regular business with, that they're going through and making sure that they're using the right comparables, meaning not only size, scope, school district, all that stuff goes into their opinion of value and selecting that comp as they're kind of moving forward. And should there ever be an issue where somebody does make a mistake, that's where we talked earlier about the whole ROV process, and we can kind of get that all into play. But again, that's part of why for Risha, we do not use AMCs. We go directly to the panel of appraisers that we have, and these are appraisers that we regularly do business, and I'm pretty confident in saying that we're pretty comfortable that they know the market and that they know what they're looking at. Again, are they perfect? No. But, again, an appraisal is an opinion of value, and they are out there trying to figure out what that is for us as we're kind of moving forward.
Now you guys can absolutely talk to the appraiser. It's false thing out there where you can call, you can connect. the only person in my group that cannot talk is me, okay? As a loan officer, I cannot. My team can. My pipeline manager who runs my business can. You can meet the appraiser. You can give him the comps. You can tell him these are the school districts. You are 100% allowed, okay? So, and once that appraisal is placed, other than me, my team can follow up and go, did you get these comps? Did you get this, right? If you let me know. So that all of that Dodd-Frank garbage that people misunderstood, it's really not the case. Other than me, anybody can call them. You can meet them, give them. I got people that go, Risha, I met your appraiser and here is a stack, right, of comps that I gave him or her to help him out. You can continue to do that. Just me, myself cannot call, all right, but my staff can. So what she's saying is same street, selling a house, school district A, not as great, 4 homes down, same street, school district B, the better school district, right? Can you use the value of 4 homes down, better school district, when your particular house is not in as good of a school district, but it is on the same street 4 houses away?
So I'm going to answer it like this, and it's going to be the biggest cop-out answer you've ever seen in your life. It all depends. It depends on those the most liked comps for that property. Is there a significant price difference between the 2 school districts as supported by sold homes in the last, 30 to 60 days? Then absolutely, the appraiser is going to take that into account. And again, just to go back to, that's why we don't use every single appraiser in every single market. We want appraisers who understand that methodology, and that they're able to go out and select the best comp for that property.
Next question.
If you don't mind, I want to expand on that just for a second. So it also depends on how the appraiser is going to define the neighborhood. So the neighborhood may be defined by that school district, or it may be defined by the busy road, or it may be defined by, maybe there's a mountain, or maybe there's something, there's some criteria that the appraiser is going to select, that the comparables, the properties that the typical buyer would also consider are going to be within that, it's not always a circle, but it's going to be in that defined area. So if that school district is kind of the driving factor, then the knowing appraiser might not consider the other homes, just depending on if that's the primary driving factor. Again, we can substitute a different thing for school district. Say it's a builder, builder A on this side of the street, builder B on that side of the street. Just because it's the same street doesn't mean that property would be ideally comparable. So again, I kind of support Chris's answer, is like, maybe. It depends.
So what I'm hearing is OriginPoint has its investor set of guidelines based on investor requirements and Fannie Mae Freddie Mac guidelines. And if a portfolio lender only goes by, because they're lending their own money, by Fannie Mae Freddie Mac guidelines, is it a fair assumption that if your investor guideline overrides Fannie Mae Freddie Mac, and I don't know if that's a possibility or not, if that's the case, that you cannot sell your loans on the secondary market?
No, not true. Not true at all. So one of the things he said is, and you may or not, is we don't have an AMC. And what that means is we're not a big bank, or we don't operate like a big bank, that we've made a deal with the company out there, like Class Appraisals or whatever, and anything and everything goes to Class Appraisals and they farm it out, right? That's typically how the big banks and all these credit unions go, is they don't do their appraisals, it's subcontracted out. When we say we don't have an AMC, what that means is we literally control the entire process, which is from start to finish. It's ordered by us, it's assigned to our appraiser, comes back, it's reviewed by us, it's reviewed by our underwriter, we fund all under it, right? The Fannie Mae Freddie Mac is a general guideline in place that almost everybody follows when they are not sure. The investor will always say, here it is. But if it's not specified, then these guys will look to Fannie and Freddie to see if there is more clarification on that. If we lend on a loan and we believe the value is right, the property is right, we will without a doubt sell it to whichever investor we originated be on, right? Like if I originated under Chase, then I will sell the loan to Chase after the loan is dead. But the beauty here, and hear me out, because I get this call, Risha, my client went to Chase directly, appraisal came in garbage, can you take over? Yes, but now it's different because it's my appraiser and not Chase's appraiser, right? So that's the difference whether I work with JP or instead of Bank of America, I work with Merrill Lynch directly, right? It's my guy. But if I originate and I fund, there is nobody from Fannie or Freddie or anybody that say I'm not buying it. Now, if there is a flaw with the property, there is something with underwriting or income, they can come back and say you need to clarify or buy back the loan, but not on property. Okay?
And just to the second part of this question is, I think, around what I call, and maybe it's not even an appropriate term, but lender overlays, right? Like, so you mentioned if I'm dealing with XYZ house, I might go to AUS. You know, if I'm working with a bridge loan, one of the 5 types of bridge loans, I might go to XYZ. You know, talk a little bit about the different overlays that each case scenario. One might be a bridge loan, one might be.
So I'll start here and then I'll get Lindsay involved. As a loan officer, I have 40-50 banks. One goal, right? And when I talk to your client on any offer that is accepted, and I'm not just saying this because you guys are here, I will call you straight up and I'll ask you, what was your list price? What did you come in at? Do you see a problem with this loan appraising, right? Is there anything I need to know? Because you put them in contract, anything goes sideways is going to be my problem, right? So I'm going to call you and you're going to say, Rish, I'm not sure about XYZ. So I'm going to go, all right, I'm going to go bank A, bank B, where we use valid appraisers from my panel that know the market. If I have a broker option, which I can send a loan wherever I want, based on whatever is right. If I am brokering it over, which is sending it to a different bank to underwrite, different bank to fund, I am subject to their appraiser. So I'm going to tell them, you wrote a no appraisal contingency. That appraisal is going to be done by ABC. I can't control it. Do you want me to go here? You want me to go here? You guys know it. You'll tell me, Rish, I want a good appraiser, right? So a broker appraisal is in their hand completely. A bridge loan where I will do a cross call, I do not control that appraisal whatsoever, right? It's all in the hands of the bank I send it to. We don't place a loan where we think it's better for us. We as a loan officer will send a loan where it works for your client and is the better deal for your client, right? It's not based on where I make more money or where OriginPoint makes more money. This is the better loan, and if brokering is better, we go there. But if there is going to be a problem, safety net behind you. If something goes wrong, we're going to move you here, right? So appraisals are placed based on where I go. For example, the rescue I'm doing yesterday, we do the loan in-house. It's our investor, but we are not allowed to underwrite it. They underwrite the loan. Appraisal, mine though. They issue the approval, my appraisers are going to do it, right? So every loan, it's not we make this up, it's predetermined. I know immediately when you get into contract, how many appraisals, is it in-house, is it broker, who's going to do it, right? But we will ask your guidance and go, here's the plan, here's what I'm thinking. Do you think I'm going to go with plan A, or do you think I should go somewhere else because you know something that I don't know?
All right. Well, I hope you did enjoy watching that. And if you have any questions about anything that you saw in there, please reach out to me. I'm sure that I can give you a pretty solid answer very, very quickly to any of those questions you may have. And if you are looking to buy a home here in the greater San Francisco Bay Area, and you do want to get connected with an OriginPoint lender or any other lender, any major bank, big or small, I know tons of lenders and would be happy to make a connection to someone solid who I think will work very well with you. All right, well, thank you so very much for watching. I really do appreciate it. And as always, please Stay tuned.